get this party started. You ready?
All right.
All right, let's go. Well, good afternoon, everyone. It's officially 12:05 p.m. Our meeting was going to start at 12, and we gave everyone 5 minutes because I know at the end of the day, y'all are still realtors, and everyone's on realtor time, which means that we'll have people getting here in 15 to 20 minutes as well. So I want to respect your time today. Thank you so much for being with us today. A couple of updates that I want to give before, oh man, I get to see myself now because I'm now in the spotlight. A couple of updates that I want to give y'all before we turn things over to Britt with Fair Texas Title. Thank you for being here, Britt, and sharing with us an economic forecast and market update. Those are things that are very, very important for us right now. But here's what I wanted to tell you. Last year for our market centers combined, we were $50 million shy of being a $1 billion group. $50 million shy. So that means this year we've got to close $250 million. So at the end of the year, we could say, hey, we're at $1.2 billion in closed volume. The per agent productivity in our market centers with our closed volume is actually some of the highest per agent productivity in our region. So congratulations on that. Y'all are doing an amazing job. Now, yeah, so let's celebrate that. And then Tim, I know in Johnson County alone, they did something pretty incredible in Johnson County last year. The closed sales volume in Johnson County was up 16.1% just in Johnson County last year. So that is a really, really astounding number. Our two other offices were pretty much even from where they were last year, which is not a bad thing during a pandemic. And for a market center to go up 16.1% during a pandemic when we were closed for a month and a half and really kind of changing our entire business model is quite a feat. So to our agents in Johnson County, way to go. Congratulations on that. And that just helps all of us as a whole group be able to, we can go out there and brag about that because most of the market centers in our region stayed dead even. They didn't grow to the amount that we as a group did. So congratulations on that. Amazing job, everyone. Now, I want to pivot for just a second and talk about the market that we're in right now. I don't know about you, but I am seeing a crazy low amount of listings out there. When I see some of y'all posting pictures that you're waiting in line and there's 15 people ahead of you to go and see the inside of a house with your client, that scares me a little bit because that means that the inventory is so low. Now, typically in this area, we have way more listings than we have. And nationally, this is not just something that we're seeing in the greater Fort Worth and Johnson County area. This is something we're seeing across the board. It doesn't matter if you're in Los Angeles, New York, Florida, Omaha, Nebraska, they don't have homes that are available. And for the first time in my career, I am seeing new home construction builders with long wait lists for people to purchase homes and even backups on new builds in case somebody falls out and isn't able to purchase the home. So we've got to be really, we've got to think a little bit differently and outside of the box with what we have going on in our current market. And here's one of the things that I wanted to share with you. I'm going to grab my trusty little whiteboard here. I'm going to have to put it on this side because I'm not left-handed and you don't want me to try. So here's what I want you to think about. When do most people call expireds? You can just type it right there in the chat box. When do most people call expireds?
Right after they expire.
They call them the morning after they expire. They usually start, January 1st, that's a good one. But they usually call them the morning after the listing expires. Now, that's great. Congratulations if you do that. Yet, here's the thing about that. How many competitors do you have that day? You have all of them. everyone who is calling, yeah, 1,423, exactly, Jeff, right on the money. You have all of them. Everyone's calling that day. People are calling starting at 6:30, 7 o'clock in the morning. And for me, if I'm a seller, it kind of pisses me off at how much action I'm getting now that my house isn't on the market. And that's great if that's the way that you gain your listings and things like that. That's fine. I'm not shaming you for that. Yet your likeliness of getting the appointment when you have 1,423 other people calling that exact same day is not nearly as high, because most of the time those sellers just don't answer the phone that day, or they wait a few days to start answering the phone. Here's what I want you to think about. In the market that we're in right now, there are days where you can look at the MLS and nothing is expiring because the market is that hot. Yes, and Shelly, they do want to break. But there are days where things aren't expiring. But there's this forgotten group of people out there that I believe is where we need to be focusing, because it is where the gold is at. The gold is right here. Do you remember back when we went into this pandemic? Well, during that time, there were things that were expiring because they were overpriced, and they weren't competitive in the market. Well, for those people who had unrealistic expectations back in the months of December, January, February, and March of 2020 and the end of 2019, their unrealistic expectations that they had may be realistic expectations today because of how hot the market actually is. So if I were back in the position of selling real estate again, I would be reaching out and looking at the MLS for those people who expired or withdrew their listings in January, February, March, and April. You see, because those are the ones that in January and February and the beginning of March, if they expired then, the pandemic didn't affect them. The pandemic really had nothing to do with the fact that they were expiring. It was probably because it was listed too high. Now, for April and May, that's when the pandemic for the end of March, April, and May, that's when the pandemic was truly affecting people who had their homes on the market. Now, we didn't see a huge decrease in sales during that time. As a matter of fact, the MLS actually went up a little bit, but there were more expireds during that time. And there were a lot more withdrawals during that time if you go and look at the MLS for that time there. We see realtors historically are not good at follow-up. So the people who had these listings originally, I would venture to guess that probably 85 to 90% of them have not been following up with those people who expired or had withdrawn listings during that time. And if you want to go and find the gold and gain more listings and have a year like you've never had before, you're going to go back and focus on these people who were forgotten about because of the effects that happened during the pandemic. Because during that time, people did not know what to expect. This was all so new, and we had to find a new normal, and people were freaking out all over the place. I know myself, I was kind of freaking out a little bit too. Figuring out what to do with our leadership teams, figuring out what to do to lead our offices during that time. And it's just a place that people forgot about. So I wanted to encourage you to look at the data from that, go into the MLS. You may want to go and door knock some of these homes directly. If you can find their numbers, call them, as long as you're following the do not call rules and regulations. Make sure you're always following the TCPA, the Telephone Consumer Protection Act, because there are some hefty fines with that. But the Telephone Consumer Protection Act will never prevent you from going and knocking on a door. So there's that. Just don't forget about that. And if you do knock on a door, wear your mask and practice physical distancing when you get there. So that is the one tip that I wanted to give you, to go and look at these, because I believe that there's a ton of gold right here, and that's where your listings sit, because those people may not know how hot the market has gotten, and the unrealistic expectations that they had at the beginning of 2020 may be what they could sell their home for today, if not more, depending on the neighborhood that they're in. So keep that in mind. A couple of other things that I wanted to go through with y'all real quick. I told you that we were going to be transitioning to having a complete digital marketplace available to y'all. And unfortunately, I had to go to California last week and take care of my family. And for those of you who supported me through that and reached out, I am so grateful for all of the calls and text messages and things like that that I received about my sister passing away. So thank you for that. And it did put me behind a little bit on a couple of things that I had been working on. So I will finish that all by the end of this week, but I wanted to show you our KW Johnson County page because every single one of our offices will look like this by the end of the week. So on here, you'll notice that for Katie, our MCA here in Johnson County, and for Candace and for Allison, our Director of First Impressions, you can simply go in there during the hours that are on that page, click a button and automatically be connected to them through Zoom. Because we know that y'all are busy, you're out places, you're doing things. And if you can't make it into the office, we wanted you to be able to have that office experience without being here. So if you need to schedule an appointment with me, there's a button you can do that on there. Kim will also have daily digital hours that she's available where you can just hop in and have one-on-one conversations with her. And we wanted to do that to make it as simple as we possibly could for you to be face-to-face. Here's one of the things that I don't know who's talking, but hey, I love it. Here's one of the things that that I believe is happening because of the transition that the pandemic has forced us to make. From here on out, everything that we do must always have a digital option. Now, if we as a market center are pivoting to that, my question for you and the thought that I want you to consider is, have I set up my personal real estate business to have a completely digital option? So do you have the ability for somebody to go to your website and click a button and schedule an appointment with you right away, or click a button and be right there face-to-face with you certain days of the week? That's something that I want you to consider, is what can that digital option look like for me in my personal real estate business? And I will have that up, like I said, by the end of the week for all of you. Our training calendars are correct on there now. So there's one training calendar with all the links for each of the offices where you can have that digital experience anytime you need it, as well as there's a lot of stuff that we're getting up on YouTube as well for our archived classes that you can go back and watch at your leisure anytime. All right, so with that being said, you've heard enough from me. Wes, Tim, Erica, do you guys have anything that you would like to add before we turn it over to the one and only Britt Fair?
Yeah, you touched on it first, Scott. Like, here's some quick numbers for Johnson County. We had 1,078 listings taken last year. That was up from the year before. 779 of those listings sold. Over 1,500 contracts written. Average sales price $265. That's amazing. Closed units, we had 1,550.
What's even more amazing about it, Tim, is if we went and looked at the year before, I believe our average sales price was closer to 220.
Yep, it was 232, something like that. And then closed volume for the office, $411 million. 411. And that gave us a total GCI of almost $11 million for our agents. That's outstanding.
So you mean $400 million in the humble little Johnson County?
Just a little OJC down here, baby. You know, we do what we can. We fire up. Thanks, y'all. Hey, great year. So proud of y'all. I can't wait to see what 2021 holds for all of us. Thank you.
There you go. Wes.
Yeah, I'm not going to miss an opportunity to take an opportunity and then see how you can help us grow our market center. So if anybody out there is sitting across the table from someone right now who you think needs our help and can benefit from being with Keller Williams, make sure we know who that is so we can get them in your profit share.
There you go. Perfect. And we've got some big growth goals for you as agents this year to help you grow your production and to continue to grow our market share at even greater levels in the Johnson County and Tarrant County and, North Texas in general. So we're going to take it all over. All right, Erica.
I just wanted to say that I'm grateful y'all showed up today, and we are all here to support you. And while we are physically distanced for the most part, it's still important to remain social. So please feel like you can call us, text us, Zoom with us, pop by the office. We're all here to support you. So I just wanted to say that.
There you go. Well,
and real quick, just a housekeeping thing. We're locked in at 100 on this call. So if anybody knows anybody who's not able to get on the Zoom call, make sure that they all know that it's on the Onward Group Facebook page as well.
Okay, perfect. I will, as soon as Britt starts taking over, I'll send out a text message and let everyone know that they can hop onto our Facebook group. All right, so y'all have heard from me, you've heard from your team leaders, and Kim, you're on here. Is there anything you wanted to add before we turn it over to Britt?
I am so grateful to be in business with each and every one of you. Wanted to give you a quick heads up because it's my most number one question. The new contracts are not out yet. As soon as they are out, you will be the first ones to know. And remind everybody that on Thursdays from 1:30 to 3, we go over contracts, addendums, or any other questions you have for legality purposes.
Yeah. And as soon as those contracts are available, Kim and I will be doing a couple of updated videos to update those portions of the contract that have changed so that you have access to that whenever you need them. So without further,
Scott and Kim,
Yes.
on that note, I took the contracts class yesterday to renew my license. It will be out February 1st. It is mandatory to use April 1st.
There
Correct.
So
Exactly.
you should have it then. Just a heads up.
Perfect. Wonderful. All right. Thank you so much, TJ. Without further ado, ladies and gentlemen, please let's give it up for Mr. Britt Fair, who's going to be giving us our economic forecast and market update. Take it away, Britt.
Woo!
Thank you. Thank you very much. Yes. Well, welcome. And here, let me see if I can get my screen share to work here. Okay, can you guys see that? Thumbs up if you can see it. Okay, I see some nods. Yes, perfect. Thank you. Well, thanks for having me. I'm excited to be back, and just a few ground rules before we get started. So number one, you don't have to take copious notes. There's gonna be a lot of data here, right? And graphs and charts, and I've seen in the past some people furiously taking notes or some people taking photographs or whatever. You can do any of that. I don't care, but I will get you a copy of these slides. I can get them to Scott or whoever y'all want to do that. Or I put Clint Blackwell in my Fort Worth office has the slides. And so I have his email address here. He's just clint@fairtexastitle.com. So you could email him and just say, hey, please give me a copy of Britt's slides. So that's ground rule number one, is we'll give you a copy so you don't have to furiously take any notes. Number two is that I want this to be fun and interactive, and Zoom has sort of made that a little bit difficult. I know some speakers want you to put things in the chat. I cannot concentrate well, and my attention span is not good enough to look at the chat and my slides. So I would say, if leadership can be monitoring the chat, and Wes, thank you. Just feel free to chime in, whether you individually or management, or leadership, if you're checking the chat and you see a question that really needs to be inserted at that moment, I'm perfectly happy to do that. So interactive is better, and I think oftentimes more interesting and timely. Okay. So without further ado, I know that this past year has kind of felt much like this roller coaster, sort of emotional roller coaster. And literally, I mean, I don't mean to diminish, obviously, the very seriousness of the pandemic and gosh, how many people have lost their jobs or their businesses, and just, and mental health and all these things that have been a real challenge. But then the numbers that Scott was just telling you, pretty amazing stuff from a real estate market and achievement standpoint, and just kind of what a wild ride it was on a positive side in many ways. So I'm going to talk some negatives. I'm going to talk some positives. And again, I think the reality is that there were both. Okay. So let's just, in one slide, go over the drama of the last 12 months, right? So this one bullet point, even pandemic, shutdowns, reopenings, all the guidance changes, protesting, rioting, looting, political drama. The economy tanked, right? The fastest and deepest recession in U.S. history.
And Britt, I believe that your first bullet point was just in March.
It probably a certain one day in March, yes.
Exactly.
So then, I know the word unprecedented was used quite a bit this past year, but I would say the unprecedented size of the stimulus package thrown at the problem by the government was fascinating. And that did help us to have the fastest and steepest recovery that we ever had in the third quarter of the US. Controversy over the Supreme Court vacancy, that seems so long ago, but yet pretty amazing stuff going on there. And then, of course, the presidential election that both parties called the most important election of a lifetime. And then the incumbent, refused to concede, and alleged voter fraud. Again, I'm not telling you stuff you don't already know. So that was kind of a wild part of 2020. And so I think my theory is that 2021 comes around and says, oh yeah, well, hold my beer. I'm going to try to be one up 2020. And so, of course, just in the first 3 weeks, we had a big runoff election in Georgia to determine who's going to control Congress. The insurrection and riots at the Capitol, the president impeached a second time, and the inauguration. So we had all of that going on just in the first 3 weeks. So we are off to an interesting start as far as trying to match the drama of 2020. And, when I used to laugh and say, oh, I just live in boring old, North Texas, and it's just this boring little market, and great market to be in, but it's just not too exciting. And I've kind of had all the excitement I really need, I think. So I long for the days of boring once again. So, but that's the last 12 months in a nutshell, and some of it's good and some of it's bad. But, I know a lot of people, it depends on how old you are, right? For a lot of people, there's always a moment in time that they remember, or certain moments in time. I think the assassination of JFK, for my parents, was kind of their moment that they remembered it. Or if people were a little younger than that, maybe the moon landing. For my generation, certainly 9/11 really stands out. But I will say that if I had to point to one moment last year, and obviously you could point to election days or whatever, but I don't know if y'all remember the day, like when you kind of had that oh my gosh moment. That was the cleaned up version of what I would really call it. But the oh my gosh moment of 2016, when you kind of realized, like, wow, this thing is real. This China virus that's way over there, like it's going to impact us. And so, I think March 16th is the date that hit for me, because I was on I took my kids to spring break, and it was that was like the Monday right after this weekend, and boom, all of a sudden the reality hit us that, and the stock market, obviously I'm showing you here, had the third biggest drop ever. And the credit markets were sort of clenching up, and mortgage markets. And, that was that moment where I, as a business owner, was thinking, and probably you as effectively owners of your own businesses as well, started thinking, oh my gosh, nobody's ever going to buy a house ever again. And in fact, we're never going to leave our own houses, and the world is coming to an end. And obviously we were all wrong, but that was that moment when, so for the younger people on the crowd who weren't around for 9/11 or don't remember it, perhaps that was the moment when you said, oh my gosh, our world may be changing forever. Now, I think maybe we're going to get over this here sooner rather than later, but pretty amazing that since March 16th, all that stuff has happened. And economically, it just creamed business. And that's what I'm showing you here is the GDP, which GDP is basically the way they measure the amount of business transactions, right? Goods and services sold in an economy. And you can see that on a quarterly basis, we were kind of boring, really. Like I said, boring seemed bad, but now I long for the boring old days. And, each quarter we would say, okay, we're about 2% better than last year, same quarter. And it would be, in that 1.5% to 3% range, somewhere in there. And we were kind of going along the same way in the first quarter of last year until mid-March when everybody had to stay at home. And seemingly the only business transactions that were going on were the toilet paper purchases that stimulated the economy, but just not quite enough to keep it from falling off. So we ended up going from positive 2% to about down 5% in the first quarter. And then the real drama hit with the second quarter, right? April, May, June, where the annualized GDP was down over 30%. And that's when I said we hit the big stimulus package. And all of a sudden, third quarter, boom, bounced back to about, by just over 30% as well. And then we've kind of been a lull since then. So the fourth quarter business, I think the final numbers will be out here in the next couple of days for the fourth quarter. But I think the estimates are generally that it was back down to 3-4%. So the big boom recovery that we saw in the third quarter has kind of slowed down pretty dramatically, right? And unfortunately, the resulting, sort of the manifestation of the reduction in goods and services purchases has really been felt on the employment situation. So I'm showing here U.S. unemployment, where, again, it was a little bit boring in January and February. You can barely see a small positive number. And then we would have had the same small positive number in March, except for the back half of March, there was a few layoffs. And then, boy, in April was when we had over $20 million jobs shed in the economy. You can see that we tried to recover May and June sort of started the uptick, but it's kind of sputtered since then. And I would say even officially in December, we actually went back negative, losing 140,000 jobs. So 9.4 million jobs lost in 2020. That's the most in any year since 1939. And really, that was the first year they kept keeping numbers. So it might have even been longer ago than that. And you can see it was almost all concentrated in such a single small time frame. Not that people aren't still losing jobs, but losing 20 million jobs in a single month is just unbelievable how fast it hit us. A few other ways of looking at employment nationally. Here are the jobless claims. You can see the first 2 weeks of March, we had sort of our normal couple 100,000 jobs lost per week, which is pretty normal, right? You're always going to have people changing jobs, losing jobs. But then boom, we got hit, with a 2x4. And you can see that there are still jobs being lost, right? Jobless claims are still in the 900,000 a month range. I'm sorry, 900,000 per week range, which means that there's still a lot of uncertainty. Now, some of these people have found jobs, right? These aren't all people still on the sidelines, but the employment situation has been tough. This is probably the best way to look at it. And this shows that approximate $9 million, gosh, I say that every time, 9 million job loss that we have not gotten back to. So we're basically 9 million jobs short of where we were before the pandemic. We've bounced back some, but the recovery has kind of lost its steam, so to speak. I show the unemployment rate only so I could remember to tell you to ignore the unemployment rate. And the reason I say that is people talk about the unemployment rate, but it's I'm going to go back a slide. This one's so much easier to understand, right? This is employed people, right? We can kind of understand that. Unemployment rate, we think we know what it means of what percentage is unemployed, but that's not really what it means, because the unemployment rate, some people get discouraged, right? They think, oh, there's a pandemic, I'm not going to go look for work. And guess what? If you're not looking for work, they don't count you as unemployed. So this is kind of a tricky way, or if you fall off the unemployment rolls because you've been on too long, you're also then no longer considered unemployed. So I would say the unemployment rate that you hear on the television and radio, I would pretty much just ignore it and just understand that going back a slide, we're 9 million jobs short of where we were before the pandemic. So looking at Texas, you can see was pretty similar, that the second half of March, and then a real doozy in April as far as job losses. And then it's been kind of hit or miss. May and June, similar to the national numbers, were big positive numbers. We're still probably doing somewhat better in Texas than they are as far as job creation across most of the country. You can see December, we created a net of 64,000 jobs, which, you know, sounds good, except we still just have a lot of people that are still unemployed. Unemployment rate, again, be careful how you use it, but you can see it has wavered here in the 7-8% for the last 6 months or so. So that's certainly better than 13% like it was in April and May, but certainly not back to where we would like to be like we were a year ago. So how are we doing in North Texas? Well, comparing DFW area to the other largest metros in the country, you can see that I love, you know, being the proud North Texan that I am. I like saying that, of course, everything's better here and everything's better in Texas, but then, I mean, you can compare us to Houston and realize that the job situation is just better here in North Texas. Phoenix and Atlanta, things are going pretty well there as well. Houston is actually, I mean, they're okay, but they have actually struggled because they still have a significant concentration in the energy sector, and the oil and gas world still has, you know, they got hit with the double whammy, both the pandemic itself and then a big price war between the Saudis and the Russians that really tanked oil prices and caused a lot of oil companies to do layoffs and to stop drilling very much. And now with the new presidential administration, it's going to be interesting as to whether the fossil fuel business actually bounces back from that, because certainly there is a lot of rhetoric about, you know, I would be nervous being in the energy sector. And obviously DFW is not immune to that either, but certainly that's why Houston's numbers have been hit worse than here in North Texas. So you got those geography things and, you know, sort of all the reasons that we have touted why it's better in North Texas, right? You know, we got the central time zone, but we also have pro jobs and no state income tax and all that. And those are all really big drivers here. But the other big driver, frankly, is the various localities and their decisions regarding lockdowns. And again, I don't know what the right thing is on lockdowns. I'm not sure that they've been very effective, but what you can say is lockdowns are bad for business. They may be good for health. I don't know, maybe not, but they certainly aren't very good for job creation. And so, you know, New York City, as an example, has had, you know, felt the need to be among the most strict on lockdowns. And so obviously the job losses are a whole lot worse there than some of the markets who have tried to be a little more balanced. So clearly lockdowns is a big driver here. And then I guess the other thing that you could talk about is industry concentrations. I mentioned oil and gas, but the tourism and travel industry is one that is, you know, I mean, we talk about bars and restaurants, and we certainly have our share of those here in North Texas as well. But as much as we'd love to be a big tourist destination, and we do have some conventions and stuff, but, you know, we're not on the tourist route like New York, San Francisco, Boston, LA, and Chicago. Those are all just bigger tourist hubs than we are. And that has been a problem. You know, Las Vegas is probably the best example of that, or Orlando, who have just been creamed because, frankly, that the travel industry, hotels and airlines and whatnot, have really been difficult. So,
hey, Britt, can I
Yes.
interject one thing? It's actually been very good for Buc-ee's with people driving all over the place. So,
you know, it is amazing. I mean, there have really been winners and losers in this thing, and not just geographically, but you are right. I mean, the automakers in general, I think, you know, I mean, the era of getting the family truckster loaded up and taking the road trip, you know, I wouldn't have wanted to do that if I could fly, say, a year ago. And now, you know, I would consider driving 15 hours to avoid airlines and airports and just the hassle. So you're totally
Yeah,
right.
and while you mentioned that, if you drive south and you go through Alvarado right there, where we have all of the RV dealerships, I've never seen them more empty than they are today. With a lack of inventory, because people are looking at things and doing things differently when it comes to vacation.
Well, and they've all driven over to the crazy gun dealer in Alvarado and buying up all the ammunition. So,
Yeah.
but yeah, so it's been, so we can always crow and say, yeah, it's, we're still not back where we want to be, but at least we're better here in North Texas than everywhere else. And
Yeah. One quick thing I also want to add, I put a link in the chat for anyone who's interested in looking at it. It's for the U.S. Bureau of Labor Statistics. You can actually go to that website and choose any county in Texas, and it'll show you what the unemployment rates are by county and even metro area. So if you're interested in that, there's a resource there for you.
BLS it's a great source of information, and it's not perfect, and like I said, there's a whole lot of nuance here, but there are some really great statistics that get updated every month from BLS. So I know that's all pretty depressing, and it's not like I love giving all the bad news, but it is what it is, and I'm not even really panicking, going in on deaths and all the things that have also happened, but I think the point of this is to say, yes, there actually is a whole lot of good news that we also want to talk about, right? And so I do want to sort of pivot and go to, okay, well, what are the good news things? Well, so number one, there is this new stimulus proposal. President Biden has proposed a new stimulus package. And before I go into the details of it, I understand, regardless of which president proposes a stimulus package, right, there are positives and negatives about it. Spending money to stimulate the economy, I mentioned the one earlier in the middle of the year, this past year, definitely helps to stimulate the economy and stimulates housing. There is a piper that ends up having to get paid at some point, which is, how do you pay the debt back? And so stimulus proposals are not perfect, and this one will also be debated. But what's in it? Well, $1,400 stimulus checks for most adult Americans. The $1,400 came from sort of somebody pulling $2,000 out of the air. And in fact, President Trump was one of those as well. And then Congress passed $600 per person instead of $2,000 in December. And so President Biden's proposing to add the $1,400 to get to this magical 2,000 number that really isn't magical. And obviously that phases out. I think the proposal is something like at $75,000 for an individual's income. Basically, they would not get the $1,400 or not get the full $1,400. Federal unemployment supplement of $400 a week through September. In December, the Congress passed a $300 a week supplement that only goes through March. And so this basically bumps it up by $100 a week and also would extend it through September. I think both of those two things have a decent chance of passing a bipartisan Congress. $160 billion to speed up vaccine distribution. I think that has a great chance of being included in the ultimate passage of this proposal. Now, keep in mind, here's what's going on. We have, I'm sure everybody knows this, the House passed an impeachment and delivered it to the Senate on Monday regarding the impeachment and trial of former President Trump. And so they've set a date that's like 2 weeks out, right, to start the trial. Well, the problem with that is that means that the Congress only really has 2 weeks to be debating these things, and obviously vaccine distribution is fairly urgent. And so that's going to be interesting to watch over the next 2 weeks. And so what I'm thinking is that the stimulus proposal that President Biden has proposed, some of these things that are no-brainers or that can get bipartisan support will be included in the ultimate passage. But then there's some other things about, here's $170 billion to help reopen closed schools. Well, it's not real clear how that works. And, we in Texas are like, what do you mean? What do you mean closed schools? Like, our schools generally have had the option anyway of being open. They actually have been forced to have that option. $350 billion to bail out state and local governments. I assure you, if this gets passed on an emergency basis, the Republicans are going to fight that tooth and nail, because frankly, that's been their hot button, that they don't want to bail out some of these places for poor spending decisions that are unrelated to COVID. So that's going to be something that really, I'm guessing, gets tossed out of this. If they're trying to pass an emergency thing to get the vaccine funded, I don't really guess that that's going to be in there. Child care tax credits, yeah, that probably, again, most people can't really, well, I think there's a decent chance of that being in there. Expand paid leave for caregivers, decent chance. But the one that's going to be just about as controversial as the state and local government stimulus money is to raise the minimum wage nationally to $15. Not exactly sure how that fits in the stimulus world. Certainly doesn't seem like part of the emergency, like vaccine distribution. So I'm imagining that and the state and local government bailouts will be probably the two things that the Republicans fight to debate another time, to not pass an emergency bill. So I would imagine that most of these things do get passed in the next 2 weeks, because like I said, I think Congress knows the urgency of some of these things to get vaccines out and get some money in some people's pockets. So I would imagine that there is some number of stimulus, let's call it $1 trillion, or, I don't know what it's going to be, but there's some number that will get passed here in the next couple of weeks before the Senate has to basically turn its attention to the impeachment trial. There has also been talk of an additional $2 million stimulus for infrastructure projects. And again, so let's keep in mind, I'll just make this comment that these are not a panacea, right? It's not all perfect. There is some very, very positive things to help people suffering from the pandemic. There's also some very positive things for immediate stimulation of our economy, creating jobs, getting more money out there to work. So those are positive things, but there is just obviously this question of how do we end up paying for it? Who's going to pay? Our kids and grandkids going to be saddled with these debts, along with the debts of recent administrations that have just racked up the national debt. So anyway, we will see, but I think there's going to be a lot of movement over the next 2 weeks before the Senate has to sort of turn its attention away from this stuff. The other thing that I would say is probably the number one real stimulus that's going on, even more so than anything the government is cranking up their printing press for, is the interest rates. This is 150 years worth of interest rates, showing the 10-year Treasury rate over 150 years. And you can see that yes, we are off the lows, but I mean, we are basically at 1%, just over 1% right now on the 10-year Treasury rate. And you can see that for 149 of those years, we didn't even get below 2. And then all of a sudden, just in the last year, have we broken to those all-time lows. So the all-time low, we got close to about 0.5% on the 10-year Treasury rate back this past summer. I think it was July. And so we're up a little bit from there, but I mean, these rates are amazing. And so back to, we were talking about the supply and demand imbalance on housing. Well, this is what's stimulating the demand, right? I mean, people are saying, oh my gosh, money is cheap. I can go and lock in, and get these great all-time great rates. And really your mortgage rates follow this same shape. That's why I show the 10-year Treasury is almost all your mortgages and your mortgage-backed securities follow the same shape with just a little bit of spread on top of the 10-year Treasury rate. If you want to look at the last 5 years of the 10-year Treasury rate, you can just see, kind of how it happened in real granular. And you can see it was in July when we got down close to 0.5% on the 10-year Treasury. So yes, we're up a little bit, but you can see that we really, especially after the pandemic, I mean, you can see how far it went from the pandemic. Basically, we took another 1.5% off of the 10-year Treasury. So, and mortgage rates, again, tend to rise and fall with this. So here's what the trend has been over the last 12 months on your 30-year mortgage, your 15-year mortgage, and your 5-year ARMs. And you can see the trend is, like I said, it matches what the 10-year Treasury is. And what you can also see on the very far right of that is there has been a little bit of an uptick, not real noticeable other than to say that as the Treasury rate has had an uptick, well, so then have mortgage rates a little bit. So does that mean that mortgage rates have bottomed out? Maybe, but they're still extremely attractive. And obviously with all the buyers being out there, I don't think this is hampering anybody's home search. I think the inventory thing is the only thing hampering the home search. I also bring up, I guess this is a positive. I think it's a positive that the stock market has rebounded. It's having a bad day today, but generally we are back at or near all-time highs. Also because low rates stimulate the value of all assets. And the reason I bring this up, well, two reasons. Number one is the third bullet point, which is the luxury home buyer. This is really important to the luxury home buyer who, maybe has stock options in their publicly traded, they're an executive with a publicly traded company, or maybe somebody is just in that world and has made a lot of money, or maybe just it's a regular average Joe who has money in an IRA or a 401k, and they feel richer. And so when they feel richer, they oftentimes will be getting into the luxury market. Doesn't really impact the mainstream market, just because most people don't own enough stock to really make that give you that feeling like I can go buy a house with this. But in the luxury market, that is true. The other thing I would say is, and I don't know how many of y'all have been following the GameStop shenanigans, but GameStop, everybody probably knows GameStop, the retailer, but it is a funny stock to watch over the last 2 weeks or so where.
Hey, Britt.
Yes.
I made $350 on GameStop stock this morning in 30 minutes, and then I got out.
I hope you got out. It is crazy. It's been up, for those of you who don't know what I'm talking about, it's up 600% in 2 weeks.
Yes.
And really the business, nothing has changed. They added a guy to their board, and that got some stock day traders all excited. And anyway, it's just funny.
Well,
but I guess my point in all that is we need to be counseling people to investing in real estate, and maybe it may not be the time to be investing in some of these high flying stocks because they're making me nervous. And GameStop is the most recent example, and it's a local example. It's a Grapevine based company.
Don't bet your entire life savings on anything that Reddit tells you to do.
Yes, you definitely need to be careful on that. And what do they say? The bigger they are, the harder they fall, or what goes up must come down. I think that's a dangerous one to own. Okay, so that leads us to housing. Okay, so this is my chart I put out. We put this out every month. My team posts it to Facebook and can send you hard copies if you like. But let's just focus on this dark blue line, right? Which is the monthly numbers of dollar volume of closings in the Netris system. Okay, and so you can see it in the left side in January. We started out with a good January. January is always the lowest month of the year, and it was the most dollar volume of closings ever for a January. Same thing in February. March got a little dicey because some of the closings that were supposed to close in the second half of the month got delayed just because everybody was kind of figuring out how do you do those kinds of things safely. And then because everybody stopped looking at houses for a month or two, right? That caused the April and May closings to fall way below what they've been in recent years. And then, between the government stimulus and all of a sudden us kind of getting stir crazy and wanting to come out of our houses, and some of the legislation that was passed, to make us essential industries and all those kinds of things, all of a sudden, all the pent up supply and pent up demand made June through December just ridiculous. I will call it ridiculously strong, ridiculously good. Obviously, the numbers that you guys were talking about earlier bear that out. That, man, there may have been some choppy waters there, but we certainly really came out of it. And so in July in particular, but you can see even in December, right? I mean, 7 months, the seventh straight month of just craziness. We were up 33% in dollar volume compared to the December of the previous year. 18% more transactions, 12% higher average sales price. So, and really the only challenge has been, as we were talking about earlier, inventory. Inventory was 1.1 months of inventory across the Netris area in November, and it went down to 0.9 months of inventory in 12/31. So the point is, that is our only challenge right now. I mean, yes, that's not to minimize the health risks of the pandemic and all those kinds of things, other than to say that from a real estate standpoint, I'm not sure we really need stimulus to help our real estate market. We need inventory to, calling on those expireds or letting people know that, man, this would be a great time to sell if you've ever considered selling, because that's the truth. And so anyway, just the market has been on fire, and I think January, from what we're seeing, is going to blow last January out of the water. So it is continuing. It'll be the lowest month of the year. It always is, but 2021 has definitely gotten off to a great start. Now, here's a sort of a one pager that we do for the city, for basically every city in North Texas, or almost every city. And I just picked Fort Worth because I know a lot of you sell in Fort Worth. Now we could do Burleson or Crowley or Mansfield or wherever. I know everybody sells in different places and concentrates. But what I wanted to show you is this slide for two reasons. A, it's informative, but then B, if you want this for any other submarket, you can send me an email, or you can, I gave you Clint at fairtexastitle.com, Clint Blackwell. He can also get you this PDF that has, I think it's like 80 different municipalities in North Texas with the breakdown by price point. But what you can see here, so I picked Fort Worth, and we have the price bands of $100,000 increments. And what you can see is and then it shows in green here, the months of inventory. And if it's green, that means it is a seller's market at that price point in that municipality. Well, you can see that there are no buyer's markets in Fort Worth. Now, maybe there are, a couple of neighborhoods. You can go to Montserrat maybe and find a few extra $1 million houses, just because there's always more supply at the high price ranges. And I'm sure I'm joking that I'm sure there are some places where it's not as crazy, but you can see at the bottom of that column, bottom of the green column, 0.79 months of inventory as of 12/31 in the city of Fort Worth. So, I mean, that is a challenge, and again, that's the other part that people don't understand about our industry is, people say, oh my gosh, it's a great, boy, it must be easy being a realtor. I'm sure y'all get that all the time. And maybe occasionally as a listing agent, maybe it's easy, but it's not even that easy because you're having to deal with the multiple offers and whatnot, but it's impossible as a buyer's agent. And I'm preaching to the choir, I know. But this inventory situation is one that I think we just need to continue to get sellers out into the market and explain. I mean, the way this works, right? I mean, in basic economics, even if you haven't really studied much economics, understanding supply and demand, right? I mean, you've heard those terms. Well, when supply is low and demand is high, ultimately the only way for those to get back into equilibrium is for prices to adjust, right? If prices go up, that will bring more sellers out of the woodwork, and it will probably kick some buyers out of the home looking process. And ultimately you will get a market back in balance. And so that's basically, in a nutshell, one of the things that's probably my number one.
Hey, Britt, quick question for you on that. Last year, when the original stimulus was passed in March, the CARES Act, the stipulation for people to be able to, with the click of 3 buttons on their mortgage website, apply for forbearance. How do you believe that may affect a influx of inventory in the next 6 to 12 months?
I think it's a good question. I hope so. I don't think we're going to have a big foreclosure wave. That usually is the sort of corollary question that gets asked, and I don't think we're going to, because of the rise in prices, right?
Yeah, there's a ton of equity there.
Yeah, most people are going to have enough equity to avoid that. I kind of hope that they stop the forbearance thing. I mean, just from a letting the market clear a little bit. And, you know, I mean, I don't know how fair it is. Well, anyway, I won't get into fairness that, so yes, I would hope that when those do happen, that will actually help our economy. Now, obviously, I don't want anybody to lose their house or whatever, but I mean, it's the pandemic is just, it's been awful, and I can't say that enough. So yes, I do think that that's going to help. Something that helps supply is there are going to be some people who need to sell. You know, and I will go one step further. I did mention the foreclosure word. I would say from a single family residences, I do expect a few foreclosures on some investment properties. And what I mean by that is if you have an investment property and you have a tenant who you cannot kick out, who is also not paying rent and doesn't pay rent for month after month after month, if we keep, if the federal government keeps doing the eviction moratoriums, at some point, some of these investment owners, these homeowners who own the homes as investments and are renting them out, aren't going to be able to pay their bills, right? Yeah. And so,
I want y'all to hear what Britt just said right there. If you have people in your database who have multiple properties, make sure you're checking in on them, especially if they are investors and have tenants. And at the same time, if you don't have those people in your database, you can always go and look at the tax record for duplicate names that pop up with the same people who own multiple properties, and find a way to build relationships with those people. Because I too, Britt, believe exactly what you're saying. Those are going to be the people where we do see some of those situations come out of.
Now, I don't know how, I don't know. It's difficult. And I guess the good news is they probably have equity as well. But you know, I'm not sure how easy it is to sell a house that has a tenant in it that you can't kick out. So that will be the challenge to that. And, you know, because if you think it's going to be a month or two, okay, then maybe you could sell the house. But if it's indefinite, then I'm not sure how many investors want to buy that house. So we'll see. So again, if I show Fort Worth here, but if you want Burleson, if you want Mansfield, you want Crowley, you want Aledo, we can get all those for you. Send me an email or send Clint at fairtexastitle.com saying that this is called the FAIR report. So say, hey, Clint, or hey, Britt, can I get the FAIR report? And we can get it to you. So this is the Case-Shiller report, which is a national group, and they picked 20 cities across North Texas. They actually picked Dallas proper. So this isn't Dallas-Fort Worth, but it's probably a pretty good proxy anyway for what's going on in North Texas. 7.2% price appreciation over the most recent year measured. This is through November. These are actually the numbers that came out today. These are the latest and greatest. Obviously, you can compare us and our price appreciation along the right-hand side there. So generally, our price appreciation is lower than most of the other cities mentioned. You know, we do have the fact that we're just not landlocked, right? Like, so, you know, San Diego is always the example I give of they're just not adding any inventory in San Diego. And frankly, even if they could, they can't build to the west because it's in the ocean, and they can't build to the south because it's in Mexico. Yeah. So it's hard, you know, they're just more of a price appreciation, a volatility of prices in places like San Diego. So, but 7.2% is crazy high for our typical North Texas, you know, sort of the boring old days of 2% a year. Normally, home builders are the answer to our prayers, right? You know, we say, oh my gosh, there's not enough, and there's so many more people moving here, and there's not enough inventory. And then voila, home builders magically do the math and they figure out how many houses to build. Well, their math is not working, because Dallas-Fort Worth led the U.S. With 35,000 home starts in 2019. And then in 2020, they started another 48,000. So they ramped it up by a third. You can see there, by more than a third, and just has not been able to satiate the increased demand that comes from low interest rates and from all the people moving here, right? In the fourth quarter, starts were up 50% versus the fourth quarter of 2019. So they've gotten the memo. They're building as fast as they can. Sales were up 29%, right? They're ratcheting up starts faster than ratchet up sales because it's not instantaneous. But the reality is there's a shortage of developed lots, right? I mean, that process, there's a lead time, right? Labor, I mean, there's just not enough skilled labor. They're building 48,000 homes a year, and they are stretched trying to find crews that can do the framing and the bricklaying and the tile setting and all the things you need, right? And building materials too, lumber shortages and whatnot have really caused some problems for these home builders. So they're really having a hard time meeting our needs. So that, whereas in many years they have sort of been that plug number where you can say, okay, we're going to stay in equilibrium because the home builders are going to build just enough to keep us on track, keep us in equilibrium. Well, we're not in equilibrium because the home builders, even though they're ramped up, they just can't build more than that. So as far as forecasting what's looking forward, I take Fannie Mae's forecast just because they know housing and they have really good economists. And I'm gonna highlight a couple things on here. The yellow is GDP forecast, right? So we'll find out in the next couple of days what the fourth quarter of 2020's GDP actually was. They're guessing that it was 3.2%. But interestingly, if you want to look at sort of what the projections are on a quarterly basis or even a full year basis for the next 2 years, you can see that on a full year basis, the projection is 5.3% and 3.6%. So good, strong growth in 2021 and 2022 to continue to try to get us out of this mess. And along with that comes the unemployment rate going down. So you can see that in pink that, at the start of the year, we were in the high sixes. And you can see that basically within 2 years, they're projecting we're going to be back down below 4%, which is back to close to record territory. We were 3.5 or so in early 2019. And that's not even, I wouldn't even call that normal. I mean, that was a record. And so Fannie Mae is expecting that when we get these shots in people's arms and open up the economy in all these places, that we're going to have a booming economy and improving the unemployment situation. As far as their housing forecast, I'll highlight 2 things on this chart. And again, it's very interesting stuff to me. I love looking at this stuff. But I highlighted in yellow the existing home sales. And again, these are national figures. I think it's actually going to be better here. But existing home sales, you can see, and I don't look at the quarterly numbers for that just because the seasonality gets really confusing and also the annualization of the numbers. So I'm showing you in yellow kind of what it has done on an annual basis. So it was flat in 2019 compared to 18. And then in 2020, despite all the craziness and the lockdowns and the panic, we had 5.8% more transactions of existing home sales in 2020 than we did in 19. And the projection from Fannie Mae is that 2021 is going to be an even better year nationally, 3.7% more transactions than even 2020. And then we might have a little bit of a lull in 2022 as they are projecting that rates are going to rise a little bit. And you can see that in the blue, what their projection is quarterly for the 30-year fixed rate mortgage. And so I take comfort in seeing, okay, if we're at 2.7% now, and again, depends on what lender you're talking to, what your credit is, but if we're at 2.7% now, and they're only projecting that we're going to get to 3% at the end of 2022, interest rates are the least of our worries. I mean, that is not enough of a move in interest rates to harm the housing market at all. Again, I think we can sell a lot of houses at 3% for 30 years. That is a reason to buy, not a reason not to buy.
Hey, Britt, one of the questions that popped up is, what are the reasons behind the GDP forecast dropping from this year to next?
GDP forecast this year to next. So obviously 2020, we know why GDP fell. So I'm going to point, we're at 2.7, down 2.7% in 2020. So you get the shots in people's arms and you're comparing year over year to a subpar 2020, really. I mean, when all in all, going down in GDP is not something we're used to doing. So 5.3 is that sort of big vaccine driven sugar high. I don't know what you want to call it. And then in 2022, that is actually not going down. The growth rate itself is going down to a somewhat more normal 3.6. Actually, 3.6 is pretty elevated, really, relative to the sort of recent years of 1.5 to 3% GDP growth. So while the growth rate is going down, GDP is actually not projected to go down in 2022. It's just not going to rise by quite as high a number, if that makes sense.
Got it.
Okay, so let's do the key takeaways and predictions, and then we can talk about any other questions and answers that the group has. So in general, obviously, 2020 was crazy and sudden how deep the recession hit us. The rapid stimulus, whether you think it was right or not, I do think it contributed mightily to the rapid bounce back that we saw in the third quarter. I do expect approval of a Biden stimulus within the next couple of weeks, trying to get something out the door that meets the emergency needs. Like I said, I don't think that he's going to get his 1.9 trillion or not, everything on the wish list. There will be certain things that they all agree on, saying we do need money for the vaccine rollouts, and we need a few things, some money in people's pockets, like the $1,400 or something. And then after the Trump trial in the Senate, then there may be some infrastructure discussions, and who knows after that. But I do think that there is going to be a stimulus package passed here in the next 2 weeks in a very bipartisan way, but I think it's going to be really stripped down. The current economic haves and have-nots are very much related to two items. Number one, the lockdown, how strict the lockdowns are in your area, as well as what industry you are in. Lockdowns, you can point to Fort Worth versus New York City and understand the freedoms that we have retained that other people haven't. And that certainly is better for business in Fort Worth than it is in New York. And then specific industries, Amazon, we can all bash them and all the booming that they've done, or Zoom, another perfect example. Nobody knew who Zoom was a year ago, and all of a sudden, what a year that I'm sure they've had in many other industries versus, bars and restaurants, entertainment venues, and those kinds of places that have really suffered. We in real estate, fortunately, have been among the haves, and we have been blessed in that way. And hopefully we will again in 2021. But the reality is, it's almost the coin flip of were you in the right spot at the right time, both geographically and industry wise. Housing specific stuff. I think that the boom is going to continue in 2021. I think we'll probably have a few more transactions overall in a year, and we're going to have significantly higher prices, probably high single digits again, because that's the only thing that we have that will help even out the supply and demand, get us toward equilibrium. We're not at equilibrium. And yes, we can go try to find more sellers, but the way you find more sellers is by having higher prices that entice them to come off the sidelines a little bit. I think apartment and condo dwellers we saw in 2020 finding single family homes more attractive. That is continuing, right? People are just not comfortable in the density situations. I think, in a couple of years, maybe we'll go back to people feeling comfortable with that and moving back to the urban walkability and those kinds of trends that we were seeing before the pandemic. But certainly in 2021, we're not there yet. And so the move toward single family and away from density is continuing in 2021. I also think suburban markets are benefiting more than sort of your urban, downtown area type things, certainly due to COVID and what I just mentioned before about apartments and condos, but also just the crime and police issues or perception of crime and police issues, city budget concerns, and, one that probably doesn't get talked about enough, but is the technology reduced commute times, right? Even if your job is in downtown Fort Worth, you can move to Burleson, you could move to Aledo, or you can move to Weatherford, and still, maybe you commute once a week or twice a week, or maybe you don't commute at all. So there is sort of this opening up of new possibilities from this technology boom. I think eventually people are going to go back and go to the office a whole lot more, but certainly in 2021, the trend is continuing that people are looking for more space. And so last takeaway I would say would be that in 2021, I expect that we're going to be as busy or busier than 2020, but it's going to be evened out a little bit more, right? So when you compare it to the first half of 2020, I think 2021 is going to look very impressive, right? We're going to have more transactions and we're going to have higher prices. The second half of 2020, yeah, prices will be higher, but I think there's actually going to be less activity than the second half of 2020, just because you saw what 2020 was, right? It was the tale of two cities or tale of two halves. And so I think when you look at the full year, there's going to be slightly more transactions and significantly higher prices. Like I said, another high single digits increase in prices that will help even out the supply and demand equilibrium. And last but not least, I think the reload boom is going to continue. You know, when there are people having to start over, right? Business entrepreneurs who've lost their restaurant, or people who are tired of taxes and have, you know, are down on their luck or whatever. A lot of people are going to be looking for a new start. And I think, again, this has been a trend for decades, really, but I think this will continue to speed up the moves here from those places with higher taxes or higher lockdowns or downtown crazy crime. You know, I mean, the stuff in Portland, for example, where, you know, I mean, at some point people just get tired of that. And so I would say that I think so. The reload boom is continuing, and so I keep saying, you know, hopefully we're going to get more supply on the market and prices will adjust, but we're also getting more demand. Demand is not slowing down, and if we have stimulus, it will pick up even more. You know, so demand will not be a problem this year. Supply is your issue, and supply is the one constraint that we have in 2021. So it's going to be a great year.
Great.
Okay, that was long and as fast as I could talk, but I don't know what other questions are out there.
If anyone has any questions, go ahead and pop them in the chat. I'll kind of summarize with a couple of things that I took away from that. You're 100% right, Britt. Inventory is going to be our issue. This is going to require you to change the way that you do things a little bit, to bring in some tactics that you may not be used to. For instance, if you closed with people in the last 18 months, their interest rate 18 months ago is dramatically different than what they could be going and closing on a house with a new interest rate today. It could be 1.5%. It could be 2% in some cases. So reaching out to those people who you've already had transactions with and asking them if they've refinanced their home. If they haven't refinanced their home, maybe now is the right time for them to consider moving up into that next price range, because chances are it could be very similar to what they're paying for the house they're currently in based upon the difference in the interest rate. So remember, that's one thing that you can be reaching out, talking to your database about. And then, like I said earlier, going and looking for those unique opportunities, like those people who may have had unrealistic expectations in the last year and a half, and bringing it back and saying, hey, you know, here's what you could probably get for your house now. And the MLS has all of that data based upon what they listed their house at before. It's just going to require a little bit of work for you to be able to do that and get that information. So somebody asked me to say what I said about multiple offers or multiple investors. I'll say that in a minute. Britt, everyone on here says thank you so much for your time and your information. If you will send that, if you'll send your presentation to me, I will send a text message out to y'all this afternoon that has the link to that presentation in it, so that you can go back and have those notes for you. What Britt just provided to us today is extremely valuable information for you to take on your listing appointments with you, so that people know how crazy our market is right now and how much in demand the greater North Texas area is for people all over the country, and not just the country, the world. So Britt, thank you so much. Anything else you wanted to add?
No, I appreciate you having me. I would say, yeah, the one other thing I would say is, so I'll get you, Scott, the presentation. And then if anybody wants those, what I call the fair reports, which are those price bands.
I have a question. I'm sorry to interrupt you, sir. I have a question, real quick. My name is Inam, and we were talking about GDP. Could you explain me what is GDP mean?
Oh, I'm sorry. Yeah, GDP is gross domestic product. And so really what that means in a nutshell to regular people like us is the amount of business activity in an economy. So think of the amount of goods that are sold or services that are sold, that those things add up to the gross domestic product of an economy. And so when I was talking about GDP earlier, I'm talking about the changes in GDP by percentage. So if there is this expectation that there is going to be 5% more business activity in 2021 than we had in 2020, I mean, that's a big jump in business activity, goods and services sold. And then I think the projection was for another 3.5% growth on top of that in 2022. So that's what GDP stands for.
Thank you, sir. Thank you, sir.
Yes. So what I was going to say was, if you want those fair reports with the price bands, send Clint Blackwell an email. And again, I'll give you his email address. It is clint@fairtexastitle.com, all spelled out. clint@fairtexastitle.com, all spelled out. And just say, hey, Clint, can you send me the fair report? And he's happy to get that to you, and anything else you need that we're just happy to serve. We want you guys to have a great success, and we'd love to be a part of that success in 2021.
James Biedenharn has a question. He said, Britt, do you see the cost of materials still increasing in 2021, or will there be some easing?
I think if rates are this low, all asset prices, interest rates, and globally, interest rates have gone way down, right? And so that means money is chasing goods and assets. And so building materials are assets. And so, no, I do not expect the prices to come down. And in fact, when you think about especially home builder related things, home builders, I think, are ramping up. I mean, I showed you DFW, we went from 35,000 housing starts to 48,000. And that's true nationally. There's so many people wanting to buy houses that the building materials that those guys are using are in more demand now than they were a year ago. And so I don't see much easing in terms of the pricing on those things. So that's going to be translated into you're having to pay a high price for those new homes as well.
Yeah. Hey, Nick, I wanted to answer your question kind of right now. So I know what you're talking about. I've seen those things as well. That's actually a complete separate company that offers that. Tim Heil out of the Southwest Market Center, he actually owns a company called Homeward. And what they do is kind of like a bridge loan to allow you to go ahead and purchase that next home. They'll finance the one that you're currently in so that you can go ahead and move while you're selling and all of that stuff. So I believe anybody can go and get certified through Tim Heil's company to be able to do that. So it's called Homeward, and it's a completely separate entity from Keller Williams altogether. And then things like Keller Offers right now, I love that we have that. And the reality of it is right now it makes absolutely zero sense whatsoever to go with an instant offer company. You would be out of your mind to go and accept an offer from an instant offer company, whether that's Keller Offers, whether that's OfferPad, whether that's Zillow Instant Offers, because you're leaving $20,000 to $30,000 on the table when you could price the home appropriately and get it off your hands in 24 hours. So you'd be crazy to go do the instant offer thing. Not going to say that you shouldn't go and get certified to that and offer that as a additional value proposition that you have in your tool belt with Keller Williams, yet it's not going to make a whole lot of sense right this moment because people aren't interested in that. Great. All right. So Britt, thank you again so much. I'll get those slides out to all of you. And then I wanted to invite Bernardo to come on and kind of give us an update real quick about what we've got going on with KW Science.
Hey, Scott, don't forget about
Hey,
the,
guys.
what you were going to tell me about the,
Yes.
real quickly, I reiterate.
I'll get there in just a second. Bernardo, you take it away.
Thank you so much. Hey guys, I had to move out of the office because Curtis is in another meeting. So I just want to let you guys know that we're back to doing our training. So if you want to become ASL KW Science certified, this is the time. So we got 3 classes signed up and ready to go for the end of February. And then another one towards the beginning of the summer. The certification classes, what it is you will get a class on deaf culture. You have another class on technology that the deaf community uses to communicate. And the third one is just a basic American Sign Language class. All of those 3 plus the real estate interpreting services membership gets you basically certified. And as we work more and more with the deaf community, obviously we try to have our clients work with those who are certified, just because you know what happens. You are much more alert to the community and things like that. So we're growing really quickly. KW Signs currently has about 22 different agents getting licensed right now throughout the United States. Our expansion team in Washington currently has about $3 million worth of listings up there. And we're started working already towards getting our expansion team in Colorado. So that's only within the last 12 months since we opened KW Signs. Anything else about it?
Hey, just real quick while you're on it, tell them what your vision originally was for this and the gap that you saw, because I think that's important for people to realize why you created this.
So the vision is not to create services to help to unify basically deaf clients with hearing clients. The idea is to change basically the system in general, so we are ADA compliant as we should. So we have the access, the right tools in order to work with the deaf community, whether it is a title company, a mortgage company, our main offices, it doesn't matter. So what we created all those tools and that infrastructure for that to happen, including the certification program. What was the other question you asked me? Sorry.
How many people did you realize didn't really have a way to be served that buy homes every year? Because that was a huge gap.
It's a huge gap. So about 10% of the market. So we're leaving just about 10% of just the national market in general on the table. So the numbers are massive.
Yeah, there you go.
And like I said, we have approximately 22 different deaf individuals getting their licenses, and they're all going to be all over the United States. Currently, we have a network in 22 different states. Don't quote me on it, but I think about 32, 35 different agents who are already ASL or who have some, how can I say this? Either they are ASL fluent or have worked with the deaf community who are part of our network. So when we get a deaf client from anywhere in the United States, we're able to help them with finding an agent who understands their culture and can communicate with them in their language.
There you go. All right, Bernardo, thank you so much for that. Stacy, you can go to kw-signs.com for more information about it. And there's information on how you can become certified for that on the website. Correct. So thank you once again, Bernardo. One more time, TJ, I'll explain to you what I was talking about when you're looking at your database, based upon what Britt said of there being people who are in these positions where they own multiple homes, and there's been a moratorium placed on those people for not being able to evict individuals. Reaching out to them and offering to be a resource and help them to just help them to be able to navigate the process. They're not going to be able to figure it out on their own. And so being there as a resource. So if you have people who are multiple property owners, reach out to them and just, number one, check in to see how they're doing. That's our first and most important responsibility always, is just checking in on our database. The sales side of it always comes second. Remember, Gary talks about service first. first, sales second. That is always the case. Don't ever forget that. If you forget that, you're going to lose your way. Service first, sales second. And then adding to your database, if you don't have people who are multiple property owners in your database, you can always utilize the tax records to find those people who do own multiple properties within the county and find a way to build a relationship with them, whether that's sending them a handwritten note to the address that they have on file for the taxes, or that's going and finding out which of those homes they actually live in, if any of them, knocking on the door and saying, hey, I noticed that you have multiple properties. I just wanted to see how the market's treating you. We have a responsibility to help people right now. And that can be a really, really big relief for you to reach out to somebody and let them know that you're there to serve them in that way. Hope that answers the question.
Appreciate it.
Okay, one final thing that I wanted to also let you guys know, we created a partnership with OneGuard Home Warranty, and you can use any home warranty company that you want to, obviously, but on our vendor page, it's not on there yet, it will be this afternoon. Whenever you order a home warranty, if you order it through OneGuard Home Warranty, they actually give a small portion of that home warranty back to the Market Center, and that goes directly into our profit share fund. So if you're looking for ways to get additional profit share, that can be a great opportunity for you to be able to help us build our profit share up so that we become even more of a profit sharing market center. So wanted to make sure that you guys knew that. I hope you all have a wonderful day. Thank you so much for your time today. I trust that this was valuable to you, and I want to let you know we will be doing this as a group. Every single quarter, we will be having an economic forecast and market update at the beginning of each new quarter. So y'all have a wonderful day. Stay safe out there, and I look forward to seeing you in person once again as soon as we can possibly do it. I'll talk to y'all later. Bye-bye.